So we're back on a Monday with the commodity report, bringing up the stats for this month. We'll go month to date performance. So month to date performance, still got cocoa leading the way. Month to date performance, which is just today. So let's go for a full 1 month. I forgot it's the beginning of the month, so that's really kind of pointless. So let's go for the full 30 days, 1 month performance. Orange juice leading the way, 23%. Cocoa, 20%. Silver right behind that at 14.5%. Coffee, 12%. Coffee's been kind of raging back lately. It had a huge move up and then a huge move down the next day. Now it's moved back up again today, 12% in the last 30 days. Natural gas right behind that. That's starting to finally move back up again. It did have a major move up, then had a little corrective wave down. Now it's coming back up again. Wheat after that, just under 10%. Platinum, 6%. And the NASDAQ behind all of those at 3%. So once again, still on a 30-day time frame, we're seeing a lot of commodities still leading the way. All the way at the bottom, and something to always pay attention to, and I like to, when I see this at the bottom, some people panic and they go, oh man, the VIX is so low, therefore equities have to crash. I like to see the VIX at the bottom performance-wise. That doesn't mean I'm not saying, hey, there's probably going to be a pullback. The VIX is at 12. Like a 12 handle on the VIX is pretty. I mean, it was flirting with 11 there for a second. Yeah. When it gets down to those levels, like a big pop's going to happen. Right. We recommended buying the VIX, basically kind of holding that trade throughout these next summer months into the election. I just don't really see it getting much under 12. I'd be surprised to see it continue down and see a 9 handle on it. That did happen to me in 2017. I remember that very distinctly of being like, yeah, all right, because we have a system that basically buys the VIX every once in a while. It's a mean reversion system. It's based on the correlation with the S&P 500. And we get these signals, we basically buy it. And so the only time it really worked poorly was in 2017. If anybody remembers that year, the VIX kind of stayed around that 12 to 9. I think it even had hit 8 at one point. Like, it was ridiculous. It was the lowest reading the VIX ever had. I'm actually going to bring that up just to double check that, because that was just so insane back then. So going back to, let's see, 2017, the VIX hit 875 at the lowest. So that's crazy. So yeah, we'll never see that again. It's the lowest mark in history. Like I would be once again, I don't want to ever say never, but we should never see the VIX under 10 like that again. I mean, that year was ridiculous, dude. If I remember correctly, like, I just remember equities were, and it wasn't like they were good equity moves. It was just this slow, boring, grueling trend. Nothing else was moving except equities, because people always talk about, oh man, the funds must have had great returns that year. It's so easy. The biggest pullback was like 4%. It was like nothing moved besides the S&P 500. Like nothing. Like tech, sure, like the Qs, the S&P 500, but everything else was trash that year. So that was an interesting time. I do not foresee us running into that, especially coming into this election. People kept talking about this being a very boring election. And now, I think it's got a little bit more exciting already.
Look, man, every day that I wake up, I'm like, we're 1 day closer to it. I'm like, dude, come on. Like, I wish we just had another 2 years of just like, we're not in a kumbaya moment by any stretch of the imagination, but it's damping down here a little bit. It's kind of like, yeah, and that's why we had that big spike. I mean, we had the VIX curve is pretty much normalized, and you had this huge spike in October, right? Because the October VIX is really going to price that in, because you won't see it really priced into the November VIX, because the October VIX pretty much prices in whatever the polls are going to say 30 days before, and usually the polls are correct. Now, they were incorrect when Donald Trump won the first time, right? And we had this like crazy downside move and then upside rally overnight when that happened, right? In the futures contracts, that was a crazy night. I remember being on the desk on that night. But yeah, man, I just like
limit down to limit up
yep.
during the 2016 election. That was
Yeah,
wild.
that was
Limit
crazy.
down to limit up. I'll
Yeah,
always remember that because usually the election nights, even though like, yeah, I'm a systematic trader, but those nights, because of the amount of volatility in the portfolio, I have to be paying attention just because of the stop losses. Like I'll get chopped to death. Even as wide as I run my stops, there can be a possibility of just getting chopped up in that meantime. So I'm usually up all night, and watching that happen in real time was just insane. But once again, it's something I always think about. You know, our recommendation was to buy something like calls on the VIX going out into November, basically selling these in late October. And the reason is think about this type of trade more like an earnings trade. So basically, like, there's no professional trader who will ever tell you to buy earnings through or buy calls through earnings or puts or any buying options in general. It sounds ridiculous during earnings. Like it's just a way to lose money because the second the earnings come out, the event premium of the option just disappears completely. And so basically you'll have times where people will be like, oh, I was completely right on this trade, and they'll still lose money. And it's because the premium has gone up so much. And if it doesn't hit that implied move, something like Snapchat was what it was on. The implied move was 20%, being just outside of that, and then you're screwed. Like, so it's kind of, so think about the election the same way. Like you need to, if you buy calls on the VIX and then you hold them, like I would suggest even going a little bit further out into December is what we suggested. But going into December, calls on the VIX, holding those and trading out of those before the election. The election risk is everything. That premium will come out of it. If you go back and just even if you don't believe in like seasonality, just look at elections in general, because events are very cyclical. So go look at the elections, watch what happens to the VIX after every single election. The VIX drops off of a cliff, which is fine. Like it's not about whether this person wins or that person wins or what's going to happen. It's just markets love certainty. Once we get some certainty of who's going to be in office, what it's going to look like, what policy could be, we're done. That's the end. So I think it's going to be an interesting one going forward to see how this all plays out. But really, like, it doesn't matter who exactly wins, how exactly this goes. It matters how do we trade it well. And that's one of the most important things that you have to know as a trader, of whether it's equities, futures, whatever it is. As a trader, understand that event premium is everything. And once we're past the event, that premium will drop off, meaning the VIX will probably fall off of a cliff as well.
Yeah. So for when you're looking at VIX options, they're a little bit more unique than what we would see from like a regular equity option, right? Well, one, you have the European settle. So sometimes when you're looking at spreads on those options, they could be a little bit funky because of the fact that you can't exercise, right? You don't have exercise risk. So the spreads could be out a little bit wider. And sometimes you can see like these very wonky type of prices here. What I would say is, I don't think it's so much the election. I think there probably could be, the election premium, I think, is trying to be built in as much as possible if you're looking at the VIX futures curve, right? And maybe we do see a continued spike to the upside. I would say everybody should brace for any sort of a challenge within the election. Let's just say that. I believe you should probably brace for that. But the election trade is probably not the right, like not the key one that, because everybody has that on their radar. It's January 6th. It's the certification of that election. And so we already saw what happened on January 6th the last time, which was crazy. If you actually probably looked at those January VIX options, that probably could be your play, because no one's probably keeping that in mind right now. It's not so much the election. We know that there's going to be challenges, there's going to be court cases and blah, blah, blah. But it's that transfer of power risk, which was very high the last time that we did this. and this time it could also be another play too. And so that would be another area where I would probably look at and say, hey, there might be a play here where, everybody's kind of focusing on that, but focus on the theatrics of what's going to happen with January 6th. Right, wrong, or indifferent if it's legal or blah, blah, blah. I don't, we're not going to get into that. But the theatrics itself could be enough to drive vol, right? Positive vol or negative vol, but that could also be priced into the VIX as well. So I kind of like your strategy, just kind of adding a little bit of a flavor there. You might get a twofer on this one, not only because of the election day events, but also the January 6th events.
Taking the options out to January is also another idea that makes sense. You could do it that way. I just think it's the general, it's weird because so we always talk about in trading, doing the trade that nobody else is seeing, sometimes it's the trade nobody else is seeing. But however, the weird thing about elections is it's the same pattern every single time. And I'll watch, you will all see this year, the second it gets to October, November, your friend that's never talked about politics ever is all of a sudden talking about politics every day. They've got stickers on their car and, they've got billboards in front of their house and so on. So you'll see that kind of happen. You'll go, wow. And then the election will come up. And the weirdest thing to me is everybody in finance should at this point really understand how the election's going to go, how the election cycle works. However, every single time the hedge funds are extremely short, all of a sudden they're building major short positions and you're just like, what did you forget that this is how this works? And they'll hold it through the election. I just find it really fascinating because it's the biggest study. Finance is really the biggest study in behavior and watching people kind of do the same thing over and over again, even though we know the pattern, it's not something that's different. So it's going to be really interesting going forward with all the different dynamics of this election. But I think in general, it's going to be, you have the volatility spikes throughout this summer, which are just normal in general and just elevated a little bit more during election years. And then after the election, we'll see volatility come off. And then there could be the possibility, like Kevin's talking about, you see volatility come off for November, December, and then you see a spike in January. That would be an interesting way to play it. So there's just so many dynamics of it, but we could go on forever about this, but let's hop into what everybody's here for. Kevin brought up a good point today, and we started doing our thumbnails will have a little bit more information on it going forward, meaning we'll be able to talk about 3 or 4 major points. The points today, let me bring it up as I'm trying to talk about it and then forgetting about it all at the same time. It is crude oil below the 200-week moving average, dollar weakness, and grains. So we'll start with crude oil below the 200. I think you sent me a chart with that one. That's the dollar.
Yeah. Let me, I'm going to also send you another chart here that I had on Friday. So actually, can we hit another one? And then let me cue that chart up. I'll send it to you. And then I can it'll give a little bit more background as to why it's a little bit of a concern.
Yeah.
It should only take me a couple of minutes. So
I got the crude one now. So
okay, perfect. So let's talk about the dollar real quick.
Okay.
Let me see if I can get this because I want to screenshot this to you because I think this actually speaks volume. All right, so we have the dollar, right? So we have this wedge pattern. We talked about this last week where we have this kind of decision that should be made here in a few weeks, hopefully, right? And that actually could be happening this week where we come up to this apex of this triangle. Now, it's an ascending triangle, meaning that the dollar is making higher lows on a relative basis. For the most part, let's say it's making lower highs, so maybe you can kind of call that asymmetrical, but I think the higher lows are really a key thing here. But the thing that I'm actually going to be watching this week is not only the economic data that we have here in the United States, which we have a lot of it, but it's going to also be what happens with the ECB. Now, the ECB will come up with their rate decision on Thursday, and it is expected that they may cut rates. I don't think it's 100% priced yet. I believe it's 65, 70% chance that they actually could cut rates. And we've been having this debate, and I've been on Spaces and all this stuff last couple of days and having the debate, well, what's that going to do for the dollar? The euro really drives the dollar index. For those that don't know, the euro is around, let's say 57% to say 60% of the dollars in the dollar index weighting. So let's put it in perspective here. If the yen actually gains strength, and let's say gain strength by 1%, but the euro also, let's say, which would bring the dollar down, but let's say the euro also loses strength by 2%, dollar index will still go up. Even though we are seeing like the yen also making some advancing moves, the power of the euro is like the equivalent of the Mag 7 times 3 for the dollar index. The reason why I kind of bring this up here, the Eurozone is going to be cutting, and not cutting because of economic turmoil per se, right? Like they already kind of, for the most part, let's say that they went through a recession last year. You can kind of make the points, well, maybe they didn't because they had revisions, all this stuff, but they had an economic slowdown at least. And now they are seeing the right trends, the disinflationary trends when it comes to inflation. They did get a little bit of a hotter print last week, but they might be putting that aside. So what can a euro cut do for the dollar? Traditionally, Jason, we would see potentially the dollar going up, the euro actually losing value, right? And the dollar strengthening value when you cut rates. That's the traditional method. But I am of the belief that we will see the dollar decline and retrace this week because of that cut, because it's not an economic turmoil cut. It's a all clear pseudo mission accomplished type of moment. And you can see not only from a positioning standpoint, those that are shorting the yen, or not the yen, those that are shorting the euro, buying back those contracts. We could actually see that with flows in the CME futures over the last couple of weeks. But also the prospects that they would be able to have economic expansion, or they're going to be able to grow rapidly, which could also create this flight to the Eurozone equities and things of that nature. So I think that we actually may see the dollar break to the downside and actually start the formation of breaking this particular triangle formation here. And that's why I'm keeping my eye out on that. And two areas of the market that I think should be really good signals of this. And unfortunately, one is breaking down horribly today. And the other one we can talk about is grains. Energy and grains are going to be the two most price sensitive commodities to the dollar, in my opinion. Okay. You could kind of say maybe it's going to be equities. I don't think so. I think it's going to be the grains. And the reason why we say that is because a weaker dollar generally should be supportive for export demand, right? The dollar is weaker. The notational value of our grains also get cheaper. The notational value or the purchasing power also kind of gets cheaper when you're looking at energy products. That should spark export demand. Inverse relationship, we should see those prices kind of advancing, right? Now, I'm not calling for these things to advance. What I'm saying is be careful, be aware of that relationship, because we did not have commodity markets respect the upside move when dollar was rising. We saw commodity prices rise. Are we going to see the market respect the downside move? That's a question mark that I don't know. I don't know that. But we're in this really good sweet spot right now. And the reason why I say that, the grain market has had a hell of a run in the upside. You and I have had this conversation. We've been talking about it. We've been doing really well on that one. But now we're starting to see weather premiums starting to be backed out of a lot of these grains. And then there's some technical levels, especially when you're looking at corn, that it has to really overcome. I believe it's the 200-week average, which I love to look at. But if we have these technical levels and we have the price action kind of say, hey, we should see a little bit of a pullback in grains this week, which we should, barring everything else that we're talking about, take the ECB out of it. If you just look at the price action, grain should fade. If you look at the weather premium that's being built in for a lot of these commodities, ex corn, grain should fade, right? Soybeans, the weather patterns for the next 14 days look very favorable for soybean growth. We could see a rotation from those that are planting corn going into soybeans because just the late planting season. We should have higher than expected soybean harvest this year. This is all the perceptions that we have for right now this week, which is why you're seeing grains already fade. But if grains are fading because of the technical nature and the fundamental nature of that market, but they catch a bid because of the dollar weakness, I think that's telling for the inflation narrative, meaning inflation could actually spike back to the upside if the market respects it. And if it doesn't respect it, I think we're going to be in a new regime. And we talked about this last week, and I'll kick it back. everybody's been focusing so much on the 10-year, and rightfully so. It's been a really good correlation trade for the most part, right? We had a disconnect of that happening last year, and that disconnect is because of a secular trend in AI, which when you have secular trends discount and could care less about any other macro factor that's going on. People are just saying, hey, AI is going to be a thing we're spending. But if we start seeing a breakdown in that correlation, if we don't see a strong correlation with lower dollar, and we still see grains going lower, we still see energy going lower, I think that foretells two things. One, we probably will have a pullback in all commodities. Two, I think the market then is going to be pricing in lower growth. And so that's why I'm keeping my eye out on energy and grains, and it's because of the dollar. And if you're a bull, you'd like to see dollar weakness, commodities moving up. If you're a bear, if you see dollar weakness, commodities going down, there might be a new shift, a secular shift that takes place in the overall commodity space. So that's what I'm kind of keeping my eye out on. I will send you that chart. What are your thoughts regarding that? We're not trying to call markets, but once again, we look at these puzzle pieces and try to build out a mosaic, and how one thing can actually have a correlation or may not have a correlation with the other one. And you build out trade strategies, or you build out trade structures based on those pieces. What are your thoughts on that, Jason?
Yeah, so I mean, so when I look at just basically taking, a big picture view, look at daily charts of all the currencies, which is usually what I start with if I'm trying to evaluate the dollar, and then I'll go through yields, and then I'll go through country and country. GDP to GDP ratios and so on. Like there's a million things you can look at, but basically understanding just, okay, what are the trends looking like? If I go through the most major one, and you also brought this up, which the biggest weighting in the dollar index is the euro. If I look at the euro and I go, okay, well, it's trying to turn back into an uptrend. It hasn't really, if I look at the primary trend in general, it hasn't really broken down from this flag pattern, but it hasn't broken out. Obviously, it's just the inverse of the dollar. We're seeing the same kind of thing in the dollar. It just hasn't really done too much. If we just look at the daily charts and go, okay, well, a lot of these things are trying to put in bottoms, but they all have major levels to break. The Canadian dollar, that 75 cents to the dollar, like that's really important. If we look at the Aussie dollar, it's the same thing. It's got a lot of overhead resistance right above it. The Kiwi from New Zealand, same thing. It's got a lot of overhead resistance right above it. The Great British Pound, it's got a lot of overhead resistance right above it. However, if you look at some of these, they are looking a little bit stronger than if we look at just the euro. So, for example, if we look at, the euro, and then if we look at the pound is a little bit stronger than the euro. The Aussie dollar is really trying right now. It's been trying for a while. It hasn't really made a move yet, and this is one big thing that I always try to pay attention to in the commodity cycle is the Aussie dollar. The Aussie dollar seems to move very well. Yes, people always come at me about this, and or same with Japan, when I'll be like, Japan's kind of a signal of deflation if we see the yen moving up. Like, yes, like at a certain point, the fundamentals matter, and the yen is just falling to pieces at this point. For many years, though, Japan has been kind of falling to pieces, and the yen would still work well in the right environment, meaning deflationary. That really changed in 2022 when we had higher levels of inflation going forward. So the yen being a growth slowing deflationary currency, it's still just getting smashed right now, no matter what environment we're in. So, like people say, fundamentals don't matter. They matter. It just they're not timing tools. A lot of things we use, sentiment is not a timing tool. COT reports are not timing tools. So if I'm looking at this generally, and I go also, the commodities did catch a bit of a bid this year with some dollar strength behind it. And so sometimes that there's two ways to look at that. You could look at it and go, like Kevin said, where it's, hey, the dollar's not really the commodities aren't really respecting the dollar on the way up. And you could look at it another way, meaning the commodities are showing relative strength to the dollar, which is rare. It does happen, but it's rare. And so sometimes when you see that, you could say the commodities have more upside, especially if we're looking at an environment where a lot of these currencies are also doing very well. I mean, today the outperformers are actually the Kiwi, the Aussie dollar, the Swiss franc. So I mean, those are the outperformers today, which is pretty interesting. That's not a occurrence that happens a lot, but at the same time, we're seeing a lot of bad moves in the commodity space. Seeing crude oil break some major levels. We haven't seen that in a while. It's just been stuck at this kind of an uptrend, holding its uptrend. Now it's starting to break some of those levels. That's really important. That's significant. So you're starting to see a lot of sell signals. I think that's why we saw so much selling today as well in crude oil, breaking those major levels. That's where a lot of people have their stops. That's where a lot of people have exit signals. That was a 50-day low. So, as we're seeing all that, we might see it push back up here because of that. But I would really sit on my hands here if I was anybody looking to trade or do that. I would be out of the position, wait for it to either move back up or just be out of the position and and just walk away from it for a little while. Copper, though, today, interesting one. Still kind of trying to put in a bit of a bottom here. Like it did pull back, had a great run. We've been talking about it for a while. Has this great run. Finally comes back to this major level where all of the highest volume zone. Basically, one thing that old school traders would do, something to just think about, take a very long-term chart, go to a monthly chart, take a ruler. They would put a ruler right across it and go, okay, this is where the most bars have hit, which is usually where the most resistance goes. Nowadays, we have a tool called volume by price, which does the same thing automatically for us. So now that we have volume by price, we can kind of just see where those major levels are. So that major level was hit. We did pull all the way back to it. Now we're trying to move back up off of it. So what I'm saying is, if I'm taking a big picture view at the currencies, the dollar, the commodities, and so on, I'm saying like we're right between two major regimes, and this is the thing you and I have talked about for a while. Like there's a possibility to go into growth slowing, disinflation, and everything kind of falls apart. Like that's a thing like nobody wants to talk about right now because we all want to be perma bulls forever. But it's like we could absolutely, like, we're right there. We're right there, man. You have major things like copper. Like we have major levels of commercial selling, major levels of hedge funds buying. Usually that's a bad sign for commodities. That's a late, like Kevin says, it's a late stage environment. So we could see that in copper. Silver looks very similar in the COT reports. Gold looks very similar in the COT reports. Energy is breaking down. So like take all that into consideration and you can go, okay, well, there's really the possibility here of something worse building, like something is building under the surface that's a little bit worse than most people are seeing or thinking. So I think that it could be completely right. The thing that's hard to say and what people always want to do is go, well, if the dollar goes down, the market's fine. And I don't think that's the case. There's plenty of times where the market has gone down. 2020 was very recently, and the dollar was, people don't remember that because they think of that huge dollar spike. But at the beginning of that, the dollar was breaking down. It was just moving down every single day with the market on those huge down days because people also were expecting the Fed to cut. They were expecting certain things to happen. So that makes, the market start to price in that the dollar is going to be weaker. Other countries then talk about the possibility of cutting too, which then makes their currency weaker, which then makes the dollar stronger. I mean, it's it's obviously all connected. So as it's all connected, you're going to see that whichever way we go. But right now, I really see like there's something really building under the surface, and it doesn't look good.
Yeah, look. Sometimes we can overcomplicate things, and sometimes you just have to sit back and just ask simple questions, right? So here's a simple question that I ask myself literally all the time when I'm doing my market research. Let's go to crude first, right? So crude, we had the OPEC meeting over the weekend. they're going to extend cuts till 2025. There is caveats to this whole thing too, right? Like UAE is going to increase their production by 300,000 barrels. They're expecting that to actually happen at the start of the year, but there is whispers basically that they're going to check back in October, and most likely maybe that could be the time where the UAE actually starts production, which is why we actually saw a little bit of a fade. The other reason why we had the fade today too is the PMI data came in weaker than expected on multiple fronts, from a price standpoint, and then from the headline, overall headline number. And then the only thing that was showing strength, I believe, was the employment number. But let's go back and ask the simple question. All right, we have a global expansion story that's taking place here, not only in the United States, across the globe, right? We have ramped up production here in the United States, which is, for the most part, kind of leveled off. The rate of change has gotten slower, and we have the driving season that's kind of taking place right now. And we have seen prices decline at the start of driving season. And you have OPEC continuing to have cuts, right? Mind you, they've taken millions and millions of barrels out of the marketplace in order to try to sustain prices, and prices continue to fall. Why? Right? We go back to that simple equation. What do you produce? What do you consume? What do you have as far as inventory? Right? It's very, very simple. And in my opinion, this does appear that we are having a slowing or a deceleration of growth in some respects. I think there's probably China. Look, China, I think, is actually providing some decent data. It's a lot. It's taking a little bit longer than I expected, but the China, it isn't getting worse, right? Which I think is actually a pretty big hurdle. But you have to ask yourself that simple question: why would prices be going down, knowing that for the most part everything else is staying equal, and one of the major suppliers of oil and petroleum products in the world continues to extend their own cuts? Continues to extend their own cuts if we're in a growth story? That's because we're not, right? And that's and we are seeing growth. Let me backtrack, because somebody's going to be like, oh, well, we are having growth. You're not having, you're seeing services growth and CapEx spend growth in AI segments, and some of the biggest players and biggest companies in the world continue to spend on that AI, on that CapEx, right, on that infrastructure, which is reflected in some growth. And then you have the industrial side, where once again we kind of go back to Boeing and say, well, Boeing is a huge driver of GDP. Now, Boeing itself actually delaying deliveries is going to have a monumental impact on our GDP. I think people are really underselling the chaos that's actually going on with that company. If they actually do have to delay the delivery, you cannot realize revenue until you actually deliver a product. Okay. So you can have inventory, but you can't really realize revenue until you have a product. And if they're going to slow down the production, that production is going to have an impact all the way downstream, right? All the way downstream from every single supplier, small, big, whatever, that could have on inflation. So I kind of go back and just once again ask those simple: why would crude oil break through the 200-week moving average? Now, this is Monday. Friday, we might see a complete reversal, right? We might see buyers coming in. We might not close below that 200-week moving average, but I did send you that chart. And the reason why I think it's a big deal, if we can bring it up, is because usually when we see the breakage of that 200-week moving average, it is not a good sign for the U.S. economy, and it's not a good sign for the S&P 500. Now, you're going to say, Kev, well, we have a break there in the middle of that chart that's around 2013, 2014, and the market continued to move up. And you're right. And the reason why we actually had that is because of the flooding that we saw. We had a significant amount of inventory hitting the market by OPEC in order to try to kill shale. Because if we had prices of oil going so low, the profitability of shale production would basically deter a lot of these companies from actually enacting or trying to continue those operations, which we did have we did have a bust. If you look at Oklahoma, one of the strongest areas when it came to Permian production and shale production, pretty much became almost a ghost town in some respects for those particular operations. And then when you're looking at the northern Texas, if you're looking at some of those parts, once again, kind of saw a little bit of a slowing. That's that disconnect that I say, that's a caveat. But even if you see even the brief breakdowns below the 200-week before that, what occurs with the S&P 500, even those brief breakdowns. And mind you, this is a 20-year chart. We did see pullbacks in the S&P 500. Even when you're looking at that breakdown that we had because of the shale boom and all of that, if you kind of look at it 2 years, 3 years later, we had another breakdown of that average. And that breakdown of that average, one, kind of did coincide with the correction. We tried to retest it, and then we further broke down that was the COVID situation. And then we've been kind of bouncing off of this ever since. So if you're a bull, you want to see us bounce off of this average. This average is a key area of support where buyers generally do step in. If they don't step in, that's what I'm concerned about. It's not just heating oil. Heating oil, we could have made a case for that. Transportation, when you're looking at industrial transportation, right, or if you're looking at goods transportation, it's falling off a cliff. No one's hiding that. JB Hunt's not hiding that. UPS is not hiding that. FedEx is not hiding that. You could just see it across the board. Intermodal is pretty much in a very significant slump. And Amazon probably would have seen the same thing, but they probably went through their recessionary slump, a year and a half ago, 2 years ago, when they had to start cutting expenses, right? Or they probably would have the same type of trend. What I'm trying to come back and say is the 200 week is critical. And if we break through with conviction, I'm concerned about the broader equity market because there is no trend here outside of the increase in inventory or increase in supply that came online by OPEC that really breaks this trend. And if OPEC wanted to have the same type of scenario that we had back then, 2013, 2014, Jason, they wouldn't extend their production cuts at all. And that's my biggest concern. If OPEC wanted to just destroy shale right now is the time that they could have did it. They could have came out and said, look, we're going to put an extra 1.2, let's say 2 million barrels. People think that they might have maybe 4 million, 3.5, 4 million barrels a day of capacity. Let's say they brought in 2.5 million barrels. They could have killed it. They could have dropped oil down to $50, $45, which your break evens right now are trading at around $24, $25. And then once you get through all the refining costs and the operating costs, stuff like that, it would not be profitable for the shale production. So that's why I wanted to bring that up. As you kind of talked about, we're not being doomers. We're not being bears. This is a different call than saying the S&P 500 is going to go into a major correction. This call is basically saying right now it appears that somebody is positioning for slowing. And if that slowing is going to happen, and we do see that reflected in GDP, if you're going to see that reflected, then we may have a problem down the road where the secular trends of AI won't be able to save you at some point. At some point in time, even companies that are experiencing headwinds in their core businesses will have to adjust either by cutting expenses, cutting jobs, cutting wages, cutting certain businesses, or pulling back on CapEx. They're probably not going to pull back on CapEx. They're probably going to cut back on other spending items. So long rant to say, this is why that's a big deal. Heating oil did this 3 weeks ago, 4 weeks ago. We've been talking about it. And I was like, hey, keep your eye out. Like heating oil is a leading indicator for crude. I literally said it on this segment. It's a leading indicator. Your byproducts, people get confused that crude is the leading indicator for what your byproducts are. Oh, crude oil prices are high. So now gasoline prices are high. Inverse. Your gasoline demand's higher. Gasoline prices are going to go up. So the input costs for your goods or what you're going to refine, I need to put those bad boys up. You got to push those up as well. So it's not a crude leads to everything else. It's everything else, and then the demand for everything else leads to crude prices.
No, completely agree. And another thing I was thinking about as I was looking over everything was, when we're looking at bonds, add bonds to this equation. So what we're talking about here is, what do bonds like? So this is why it's important to understand macro. If you understand what environments each asset class likes, obviously copper likes growth and inflation, oil, similar thing. But the market's not trading like that. But what likes the environment where it's growth slowing and inflation slowing? That's bonds. That's bonds. And what's been going on this last week, and I even, like, for me, I was like, the bond trade just seems pretty bad. However, I keep talking about the fact that, like, we're not moving.
He's moving, y'all.
We're not going to see what? I'm
I
not.
said he's moving.
I'm not changing.
Sounds like you're getting a little bit. It sounds like
I'm
you are
not
starting
buying
to
them. Not
open
buying
the
them.
door a little bit.
Well, you know what? I'll say
Open the
this.
door.
I'll say this. At the beginning of this year, I said I will never buy China. China looks like trash. It's obviously saying something, and then I got a buy signal in China, and I'm long China. So I'm not going to say never. I am going to say, we haven't had a buy signal in bonds in so long that it's been crazy. Like, so to me, what I think and my theory and what I keep bringing up about bonds, it isn't that we won't have tradable rallies. I keep talking about the tradable rallies. I will get a buy signal at some point. I will ride that rally or whatever. What I keep saying is I'd be very surprised to see a new high in bonds in the next 5 years. Like a new high, like the high from 2020. Like if we start taking out those highs from 2020, I'd be very surprised to see that in the next 5 years. Possibly.
Yeah, I think that's a safe call though, man, because I mean, you would have to go back and say, do you think that we're gonna see 0% interest rates again?
Yeah,
right?
so it's exactly what my thought is. Like I would be very surprised to see us get back to those levels, to start taking out those highs from 2020, because what I'm looking at really is the bond cycle. And so how the bond cycle works, it's a 40-year cycle. So bonds every 4 years do a very similar thing. They go through these 40-year uptrends and downtrends. So we've been in a 40-year uptrend since 1982. We had that crazy stagflation era in the 70s. We get a bottom in bonds at that point, and then bond prices go up for 40 years. Everybody basically goes, bonds are the best thing in the world. You got to own bonds, 60-40 portfolio. Whole retirements, everything is built, and pensions are built around that system. Then we get into 2020, we get this massive blow off top. And what's funny is, like, I was the one who was shorting the bonds in 2020, and everybody thought I was fucking insane. Now, once again, like, I was long before that, so it's not like I have a bias in it. Once the price action goes one way or another, I'm going to go that way. You hear me being the loudest bond bull after the price action goes one way, and I'll sound ridiculous. However, it's how you make money. You don't make money just going, hey, this is going to suck forever. Like, it's just not how it goes. So basically, we got that downtrend signal in 2020, and what's been crazy is it's the only signal I've ever had that was literally had one shakeout in 2022, and that was it. Sorry, it was into 2023, the beginning of 23. So we had 2020, we break down, we're downtrend. We're still in primary downtrend. We've never really gotten out of that primary downtrend that whole time. Now we're starting to see a bit of a bid in bonds. And so if we're both sitting here going, well, look at oil. It's kind of falling, finally breaking trend a bit. And we're going, okay, well, energy, besides copper is really like the thing that's like blowing my mind right now. Because it's like copper in this type of environment should be our biggest hint of what's going on. And right now it's going the other direction, which is why I keep saying we're between regimes.
Yeah.
But if we start to see the bond market continue here, like bond prices continue higher, the 30-year bond today is up over 1%. We start to see it take out those major levels. Let's say get over 120, 122, 125 even. Like, you really can't argue with that. So once again, you're going to have to go back into that uptrend. So saying that we're in a inflationary cycle is what I mean. We're in an inflationary cycle. Will we have periods of disinflation where bonds are a good performer? Yes. Will we have a situation where we go back into that major uptrend that we saw from 2020 and we start to take out those highs and continue? I'd be very surprised. Like you said, like, we'd have to go back to zero rates and even further possibly. And then the 30-year bond would have to get really low. I mean, it would be insane. So that's my main thought on it. It's not that I'm saying bonds will never go up again, because everything goes up and down. That's a ridiculous statement. It's just, are we in a situation here that's kind of stating we're going to have a disinflationary shock? I think that's very possible. I think it's looking very possible here. Copper, however, is the one that's like, it's blowing my mind. It's blowing my mind.
It is down 11% from the highs though. So I think copper trading at 465 was a key area of support there. I'm not surprised that we do see it catch a bit. And actually, I'll even go a step further. I mean, it's up 1% today, so relative basis. But I mean, if we don't see like a dramatic bounce over the next couple of days on some decent volume, I still think that thing can fade. We're still seeing an unwinding of that trade, but it should have a technical bounce here. Now, could have a technical bounce to go up another 35 cents, test that $5 level again, maybe,
and then maybe
the
it could
breakdown
come down from there.
Yeah, but yeah, I mean, yeah, this thing doesn't hold. So 465 is the area of support for me. I was thinking 450 would be the area where it tests. Like that's like your line in the sand. If it breaks 450, I think you gap down. I mean, you don't. But there is still the fundamental case there, and I think we talked about this last week. You got to be balanced with it because technically you're looking at this and say, okay, let's say it's in an uptrend, it's doing a bull flag, right? Bull flag means that it's in a bull trending market, it's pulling back a little bit, but when you call it a bull flag, it means primary trend still bullish, flagging back to the downside to test support before trying to break higher. That's what it's doing right now. I don't care what type of technician you are. That is a bull flag straight up through and through when you're looking at that chart. The key thing with bull flags, though, is when we call them, you can't assume that it's going to move back to the upside because that's what makes a bull flag. If it doesn't, then it's not a bull flag, right? And then it's a reversal pattern. It's a peak pattern, right? 465, key area support. Let's see if it's going to catch a bounce. Can it catch a bounce up to $5? For sure. Let's see what the follow through is going to be with that. And if we do see follow through with that, then I would say we have to question some of the other moves when you're looking at energy, because even the operations for smelting take energy in order to be able to do it. Now, yes, we have a supply issue, but we're going to see a fair amount of supply actually hitting the market starting now, starting today. Indonesia is saying, "Hey, free reign, go throw some stuff out there." So let's see how that reacts. Let me say this with bonds, because I have to put on and I'm not providing any advice, but I have to put on my big boy cap here real quick, because I'm in my 30s and been trading this market for a while. And those in a certain, and I think it's every generation, right? But let's say from the 80s babies to now, if you're a trader, right? Well, I don't even know where we're at right now. Gen Y is trading, I don't know, Gen X, who knows, right? From a long-term retirement portfolio standpoint, we have never had an opportunity for yields like this, for us to be adults or trading age and have yields like this for a portfolio, not talking about the trades that we talk about on a weekly basis or a monthly basis. So we have to kind of also say, bonds may not catch a bid right now. That could be the case. But look, if you're building a portfolio and you haven't had fixed income exposure because it just hasn't been there, the yield just has not been there, and we're getting kind of pseudo close to a Fed cut, I mean, you can't really turn them down for the long-term portfolio. So a small slice for those in their 30s, 40s, or even 50s if you want to check.
I completely agree, but I also do that. So I also but we have to also preface exactly what we're saying, because there's people who are going to go, okay, cool, I'll buy TLT, and it's like, no, that's not it. So not the long. So what Kevin's talking about here is the short-dated bonds. So we always have short-dated bonds in our portfolio. Things like, I mean, you could buy ETFs like SHIV, SHV, or SHY. These are the very short-dated bonds. These are very connected to what the Fed is doing. The long bonds are not connected to what the Fed is doing. Yes, they do generally go that direction. So if the Fed is cutting most of the time, rates will come down and so on. But they're not directly correlated. So to me, like Kevin's saying, I completely agree, where it's like you have bond yields all the way up here. Not to mention right now we have commodities, which not all commodities, but the most major commodity that's the biggest weight of inflation is coming down. So with that coming down, it gives the Fed more of a reason to say, hey, maybe we can cut here.
Yes.
So if you add that all together and you go, okay, I'm going to buy some short-dated bonds, you're a futures trader, like we talk about in here a lot, you want to make a trade in the euro dollar future. Well, now they call them something different. Were they LIBOR rates? I don't even know. It's ticker GE now.
Okay. Yeah, I
don't. But anyways, they changed that one recently. I don't understand. But anyways, short dated bonds. Your futures trader, you want to buy 2-year bonds. You want to buy 1 month to 3 month bonds. Whatever you're doing, you can do something like that. That keeps you on the front end of the curve. Or like Kevin said, buying the long end of the portfolio makes a lot of sense too. The long-term portfolio. I'm getting mixed up.
Long-term, like you're looking at long-term portfolio, something like that. Yeah, like
buying short-term dated bonds.
Yep. Yeah, if you're out, if it's not in like an IRA, because like then you can probably go out into the corporate structure, get a higher yield. Obviously, this ain't the show for that, but I think we have to. I think it goes overlooked a lot when we kind of talk about, oh man, like yields, like they don't look like hey, like we were trading at like a quarter of 1%, 0.5%. You're looking at what, 1.25%. I mean, we're seeing rates right now where they seem like they're once in a generation especially for those 90s babies out there, and then early 2000s maybe. The 80s babies, they had their fun, right? They saw some things, but I just wanted to kind of preface that. Yields. Once again, I look the dollar, and I think yields actually just range out. I mean,
5% is 5%, man. I think that's also something people in general look at markets in some magical way. That they go, if I just learn how to trade, I'm going to make so much. And it's like, if you could just if you're 20 and you're netting 5% a year till you're 70, you've probably made some money. Like that's not a bad thing.
Yeah, if you compound it.
Yes, sure. It's compounding that all those years, adding to it. You've made some money, and you've made more money than most general people who are trading. Obviously, I think you should have some more stocks in there too, but I'm just saying, like to echo what you said, I think it's important because people are our age and younger. We've never had any reason to own bonds for the most part.
Yeah.
The yields have been trash. They've moved a little bit. It's been a fun trading vehicle here and there, but owning them long term, our parents got 15, 20, 30% rates at times, depending on where they're at in the curve. We've never seen.
They bought $50,000, right?
Yeah. Well, they always talk about their crazy rates they had in their mortgages, and then you go, well, your house was like $20K back then, so there might be something different there.
Hey man, real quick, I just want to go through. Look, I'm looking at grains pullback. I think corn's the best looking out of. I like wheat too, but once again, the weather premium's kind of backing off of wheat. But I think corn probably will see a little bit of a pullback, but they look at the best of the out of them all. Copper, we had once again technical bounce right now. Barring anything changing, I just don't see it. I don't see it sustaining here. I see it sustaining at $4, and I think that even if you look at $4 coming off of those October lows, it's still like that's a crazy return for copper. But we'll see how that goes. And then the only other one, you know what everybody's been talking about lately, which I find very hilarious. This is where you know that the metals trade is getting very long in the tooth. This is when you know. When people try to are talking about platinum. Now, you can make a case because platinum and palladium are heavily shorted. Now, let's kind of take palladium out of it. I love to see palladium when it catches a bid because it only trades like 1,000 contracts, maybe 1,100 contracts a day.
Yeah.
Those that have been like shorting it, once you do see the squeeze, like the squeeze is just so worth it. It's so worth it when you see a palladium short. If you haven't seen one, guys, by all means, next time it happens, I will definitely, I always call them out. They're hilarious. Platinum, though, is actually decent.
I've never heard people.
Yeah, I'm like, I saw a couple of posts yesterday, and everybody's like, "Oh, how can I gain exposure, ETF exposure?" Now, if we want to bring up a chart, like a weekly chart, it looks like it's in a topping formation. It looks like it's going to pull back here a little bit. I think there's a lot of optimism of if you look at the ratio between platinum and then gold and or silver, it's at like one of the lowest historical levels that we've seen, right? And everybody's getting into these ratio charts too. And ratio charts are phenomenal charts to say the least. But I think context is also key. So sometimes like when you look at platinum, or if you're looking at palladium, you're like, oh man, this is going to be the catch-up trade. Understand that like
very different dynamics.
Yeah, and they're used differently, and sometimes it's just the industry as a whole, as a commodity, just falls out of favor in the industrial side. And sometimes you can catch those short squeezes. I think another one that's really popular right now, everybody's talking about the SPX and RSV, or looking at the equal weight S&P 500 and blah, 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 and like inferring all of these like correlation to it. Yes, will we see a bid being caught up for those that have been sold out? For sure. But don't make that like your overall base case for the remaining half of this year. You got to still be a little bit calculated and tactical with it, to say the least here. But yeah, platinum actually looks pretty decent. Natural gas, it did pull back, by the way. Now we are seeing it catch a little bit more of a weather bid. So we have to understand now the weather bid is how many warm days we're having this year. It's not the fact that we're expecting a lot of colder days this year. So every week we kind of get that updated. And every week it seems like we're expecting more and more warmer days and hotter days. I think Denver is expecting a pretty hot summer, as well as one of the worst, I think it's like in the last 10 years or 15 years. I just read the article yesterday. One of the worst natural disaster events in Colorado is being expected for this year as well, which can also boost natural gas in a sense. Yeah. So catching a little bit of a bid. I saw it did a decent little pullback about 2 weeks ago. I don't know. What do you think? It looks like it's trying to do a little bit of a cup and handle here, man. Like, I mean, it's still gonna have to take some time on the weekly time frame. Like, it has to hit like 330 to be able to confirm that. But I think it's an uphill battle. But somebody keeps coming in and stepping into this trade.
Somebody's interested. Yes. Once again, it's the natural gas trade. It is in an uptrend. But you have to be it's somebody wrote me the other day and they were like, yeah, I just can't trade it. I always lose money, and like I always buy at the wrong time. And it's like
you and me both, dude.
everybody in the
I've had one literally just knock. It was a couple of years ago where I just got super lucky one day. Like I was long like 2 contracts. This is a couple of years ago, right?
Yeah.
It's more than a couple of years. It has to be about like 7 years ago, 8 years ago. So I was long 2 netty options contracts. And dude, it was just one of those like stars aligned. I put the trade on, and then I don't know what happened, but like overnight, you're on your phone. Let me check what my positions are. And this thing like just took
skyrockets.
And I was just like, So it was a situation where it's like the markets were so wide. And then after that, I just like to have full disclosure. After that, I was like, dude, I'm a natural gas trading king. Deal with me. Yes. And I traded away all of those gains in a matter of like 2 weeks, 3 weeks. Just that whole thing just got faded away. Mm-hmm. So you get like the one trade that makes you feel like really happy when you're talking about natural gas, because that is a very hard market to tame. But you gotta be able to, like, once you take your money off, look at something else, because if you try to double down on it, it's gonna reverse whatever way it was going. It's gonna reverse whatever sentiment that you have. It's a heartbreaker, man.
No, dude, I totally agree, and it's something that happens so much. And I think the only and I used to just destroy myself trading natural gas every single time, and I didn't understand why. And I'd run systems and strategies, and it wasn't really until I really added my stop loss into those back tests that I understood the reason why. It was because you really have to. It's the reason why I would say if you want to trade natural gas, trade incredibly small. And the reason why is because it has to have that room. Like, think about it even today. Like, let's say you took a trade on it today. Let's say you had a 2% stop loss. Well, you got chopped up. And then let's say you put another 2% stop loss. Well, you got chopped up again. So you have to literally trade this thing so small that you have the widest stop loss in history. Really, I mean, it's the only wider stop loss we have in the portfolio is Bitcoin. So Bitcoin is the most volatile asset in history, and natural gas is right behind it. So you have to have nearly a 20-30% trailing stop, which means your position has to be so small. So once again, it's like, it's really hard to do. It's really hard to trade. You have to have a specific portfolio size to do it. Yes, you could trade the smaller contract. You just have to understand, like, there are smaller contracts. So try to trade the smallest contract you can. There's other people who trade CFDs. However, you have to do it to have the smallest position possible. And this way you can make money trading it because it does trend. It does move. It moves like everything else, except for the trends are just like this.
Yeah.
So I mean, if it's going to trend with that type of volatility, you just have to be really wide on your stop losses. But I think, generally natural gas still bullish just because the trend, for me, that's how everything goes. Positioning isn't that bad yet. Everything going into seasonality wise, everything else looks okay right now. So I'm not really looking at any major headwinds. But that's about it. I got a question, which was stop loss as well as an exit. Yes, stop loss always as well as an exit. You should never want to get out of a trade using your stop. This is something that's always kind of misunderstood in trading. If I'm a futures trader, I'm talking, if I'm Jerry Parker or any of these guys, we all do kind of very similar things. Whereas if we're running a trend following system, the stop is going to be basically to risk manage. Okay, my max loss is 1% of my overall portfolio. So if I have a position that's $10,000, I'm going to lose $1,000 on that position at most using my stop. But I'm hoping to get out better than that. I'm hoping to get out with my exit. And so my exit is usually going to be better than that. The only time you're really going to hit a stop loss is like if you have something catastrophic happen at the beginning of a trade, or you're in a parabolic trend like cocoa and it crashes, like things like that. That's when your stop loss is going to get hit.
Market opens and stuff like that, right?
Yeah, weird market opens, things like that. So you shouldn't really get hit on your stop ever. That's why you size your stop loss to the volatility of each product. So like I said, with natural gas, it's maybe 25% trailing stop. Bitcoin's a 30% trailing stop. And then if you have something like bonds, like it's more like 10%, even less. Sometimes currencies can be 10%, even less. Equities are like, if we're talking about equity indexes like SPY or whatever, that's going to be something different. That's going to be like 14, 15%. So, just understanding the volatility of each product and how those all move around is very important, because you want to keep the same win rate of your system, but also just have the stop there just as a way to manage risk and in case the worst scenario happens.
Yep. Hey, there was another question there. What was it about Israel? Right.
This one
about the conflicts. Let me see real quick.
I brought it up. It's on screen.
Okay. Does what's going on in Israel affect commodities? It did briefly.
Yeah.
So the thing with Israel that you have to kind of keep in mind in this conflict, the biggest fear that we had at the beginning of it was obviously on the energy front, but it's not the fact Israel is not an energy producer by any stretch of the imagination. I think it has like maybe one or two operations, and they consume everything in house, and they have to import in, right? They do have a refining operation in the north, I believe, but that's pretty much it, right? So it's not like they're a major player there. The concern was obviously logistics, and we saw the adjustment in logistics when it came to the Red Sea, and we're still seeing that. The fact that we have the Suez Canal pretty much just dried up as far as actual traffic. I mean, it's down like 90%, 95% from its average that we saw just a year and a half ago or a year ago. Those logistical fears have now faded, especially now we have seen a little bit of de-escalation with Iran. I think that's another reason why we're not seeing any type of geopolitical premium being priced in. Also, kind of keep this in mind, and I'm not a geopolitical strategist, but I follow this stuff a lot. So I'm not, I won't take the official title, but a lot of the macro things that I do focus on also include the geopolitical element. I'm not saying that the U.S. is disconnecting from Israel by any stretch of the imagination, but you can start hearing that we're having a little bit more of a measured tone when it comes to this conflict, right? That also reduces the geopolitical risk premium in the market because we're going to be a little bit more balanced rather than going full port, if you will. And I'm not trying to have any type of political side to this, but just trying to put it together. Israel and Hamas is not the political risk or geopolitical risk you need to focus on right now. It's a big issue. We're talking trading. I'm sorry, let me say, we're talking trading. That's not the issue when you're looking at trading. It's going to be Russia, Ukraine. Russia, Ukraine is the big issue right now that is escalating under the surface to levels that we have not seen since the Cold War, probably even worse than that at this point, especially since NATO, a lot of NATO countries have now given the green light for offensive attacks in Russia borderline territories, right? Which is a very big red line. That's the one where you got to keep in. That's the one where if there's a natty play, it's weather. I think the natty play is more geopolitical than it is weather right now. That's just me. And if that play is going to be there, LNG is going to be a part of that. You can look at Cheniere Energy. That is a very interesting play from LNG standpoint. And if you look at their multiple, it's absolutely ridiculous. Now, people can say, well, the stock has already moved up. It's kind of range bound here a little bit. That stock's got like a 4 multiple, 5 forward multiple. They trade long contracts on LNG. So when they get the new contracts, they go out long dated derivatives and hedge that portfolio. Now, what does that do? That obviously locks in their prices, but they could have like these short-term gains and losses on their portfolio because of the adjustments to the derivatives that they have on their books. But that locks in long-term revenue gains. If we have spikes in LNG demand or spikes in LNG prices, once again, they're going to get interest from buyers. They lock those in at higher prices. It's like this circling effect. It's a different company than any other energy producer that is out there and the way that they manage their business. And they are one of the bigger players here in the United States. And if we do see an expansion in LNG, they're going to be a beneficiary of that. I'm not recommending that stock, but that's the one that has probably the most LNG exposure here in the United States. The other one that has LNG exposure is going to be Shell, Royal Dutch. Shell, right? But I don't know. I don't like playing ADRs when it comes to the energy trade. All that to go back to say, Russia, Ukraine, bigger conflict, bigger concern for me. I think that's the one that could pop off things considerably across the commodity spectrum. Russia knows that. The European Union knows that. The United States knows that. So there's a lot of stuff happening under the hood right now, and you don't want to see that spark, because that spark that spark could actually put us back a year and a half on the inflation front.
For sure.
That's basically brass tacks right there.
So I got another comment which I thought was interesting. I'll just end with this one, which is 10 to 14% stop loss for ES is too wide. So I guess to start off, one is this is what I do. I'm not one of the people who's just on here talking about trading. I'm actually a trader. That's my full-time job. That's why I put out all this information for free for the most part. I enjoy doing it. But so when we're looking at stop losses, you're looking at the volatility of product, but it's not only that, it's also the time frame. So if you're trading if you're a day trader, no, you would not use a 10% trailing stop on the E-minis. That wouldn't make sense, because the average move per day would very rarely, the average would ever be 10%. It's happened. That's crash scenario though. So that's not something scenario. That's not something you would go, okay, I'm going to be in a 10% move for that. But if I'm in a trade for a year, 6 months to a year, which is my time frame, 10% pullbacks happen. And not to mention, we're also talking about stop losses are catastrophic. So stop losses being catastrophic, it's not how I want to exit any trade. Just to size my trade, worst case scenario, one of these stops gets hit. So I'm going to have a stop loss that's at wide for that reason. It's not going to be to exit. I don't want to exit 10% down most of the time. However, I'm going to have that stop loss there just in case, to size the position And, once again, it's all time frame. So, on a daily time frame, if 5% would be pretty wide on a daily time frame, possibly too wide on a daily time frame. But 5%, if you're doing a 1 month or swing trading type of time frame, 5% might make some sense. 10% if you're on a longer term time frame. If you're a person who's going to hold the trade for 2 years, even, it might be even wider than 10 to 15%. You could have 20% pullbacks within inside of these things. And that's if you study it over time. If you studied it in the last, few years, you'd go, okay, well, obviously the market doesn't pull back that bad. But if you study the market and you go back, 40, 50 years, which is looking over all different types of market environments, you would see that there's different types of pullbacks and different types of environments. And what you want to do with your stop loss is put it so it's out of the way, so you're not getting chopped in and out of trades, because you just lose money that way. If you back test it, you'll see that you actually make a lot more money trading and having a very wide stop. That's why people hate stops, honestly. Like everybody's like, I hate stop losses, and that's the reason why.
Yeah, and then like also too, just keep in mind you trail those stops up too. It's not like you put the position on, like, and we're just going to use like just basic numbers here, right? It's not like you enter the ES at 5,000 even. You got your 10% stop loss there, right? So that would put you at 4,500, right? And it's not like S&P goes up to 5,200 and you still got your stop sitting at 4,500.
Exactly.
Like, that's not how it goes. You run those up, you run it up. So what Jason's basically saying is that the probability and time frame that you give yourself for a long move in the equity market in general is actually more favorable for those larger stop losses, because it's a rare occurrence for those corrections to actually occur. And in the marketplace that in theory and in actuality has the ability to grow based on dollar multiples themselves, right? The multiplication of money and dollar flows gives equity markets the edge of upside potential rather than downside risk. And so I think that's kind of the flavor that you're talking about. We're kind of thinking of it right now and saying, yeah, dude, like $500 loss on the S&P 500 point loss on the S&P 500 is actually very substantial, especially if you multiply that by $50. But the likelihood of a correction of 10%, now they can happen every year, but you would have to. Basically, what I'm trying to say is this: unless you're like a very unlucky trader and you put that trade on and that was peak, your trail stop should actually advance, and it wouldn't be a theoretical 10% loss, right? We should have a melt up in price. We have a little bit of move down. You're moving your stops up. You're moving your stops up, and at some point in time, you have greater gains than what those losses are, right? Like I think that would be
time, I mean, it's all just like experience of back testing. And once you back test it, you experience it, you live through it, then it's like I completely see it, but I'm trying to more explain it so other people grasp it too, just like you did, like you illustrated that well. And hopefully we're illustrating these things well so other people can get it. And most of the trades end up, with the trailing stop, a lot of trades just end up slight losses or slight gains, like it moves up before it moves down a lot of the time. So, you run into that quite a bit. So it just protects you. At the end of the day, like, you can't think of trading in a way where it's like this magical thing that makes money. You have to think of it as a magical way to lose money. And as long as you're thinking about it as a magical way to lose money and you're always protecting your ass, like, you will make money over time. So because basically the hardest thing to make money from is huge drawdowns. You have small drawdowns, you make good money into the upside, you will continue to make money over time. So.
Yeah. Hey, I know we're going to wrap it up here real quick. I just want to reiterate the fact. I think we talked about it last week. Everybody's been, I think we actually talked about it today, right? Yields down, equities go higher, blah, blah. That's been the trade. Look, that trade is starting to break down. Starting to break down. So just be mindful of that. We have yields down today at a pretty healthy clip. We have equity markets right now sliding down about 0.6%. You got the dollar down about 0.5%, give or take. You got equity markets down. We talked about the new regime. It seems like that is kind of taking place lower yields is not automatically going to fuel equity gains these days. We had the same thing on Friday. We had the technical kind of shift thing that occurred month end, rebalancing, SPX flows, 5,200 key area for gamma, all of that stuff. Threw that in the pot, stirred that up, created that like fall crush move that we saw at the end of the day. But the writing was kind of all on the wall, if you will, to start off the day. And it was the similar situation. Yields lower, dollar lower, equities lower. So be mindful, be careful of that. If that has been your strategy, kind of look at some other areas or maybe put on some additional risk parameters in place or some checks for your trades, because I feel like that is going to be the whipsaw effect that that retail traders may have that might have just gotten into this game 2 years ago, a year ago, 2 years ago, where that has been the bread and butter for sure. This thing might shift on us. So wanted to keep it at that. Jason, I always appreciate you, dude.
Yeah, man, this was fun. Let's see you again next week or today or tomorrow on Spaces, I think.
For sure. Yeah, I will be on Spaces. All right. Hey, you guys have a good one.
See you soon, man. Take it easy.